Mortgage applications are still decreasing, interest rates are back to 20-year highs, and lending standards are tightening. All of this impacting home buying demand in the US of A. Good afternoon, this is Oliver, your Bay Area Realtor, and for today's video, we're going to be looking at the current mortgage market because it is not looking too good. Before we begin, if you enjoy me making these videos, please like the video. This will help support my channel and home buyers like yourself who are looking to buy a home in the Bay Area. Also, do consider subscribing if you want to stay on top of the mortgage market and real estate market in the Bay Area. Now, with out of the way, let's cue up the intro. So right here, I have the most latest press release from the MBA, the Mortgage Bankers Association. They have these really good press releases that explain how the overall mortgage market is doing for the week. Specifically, they look at the market composite index, which is a measurement of mortgage loan application volume, along with other indexes such as the refinance index and the purchase index. So for the week ending in October 7th, 2022, the market composite index decreased by 2% on a seasonally adjusted basis from 1 week earlier. The refinance index decreased by 2% from the previous week and was 86% lower than the same week 1 year ago. The unadjusted purchase index decreased by 2% compared with the previous week and was 39% lower than the same week 1 year ago. So overall, we're seeing a continued decrease in mortgage loan application volume. This is obviously due to the increase in mortgage rates. We've seen the rates go up to now 7% for a typical 30-year fixed mortgage. This has affected other loan types such as refinancing, which is down another 2% and 86% lower than the same week 1 year ago. The unadjusted purchase index decreased by 2% as well and was 39% lower than the same week 1 year ago as well. Overall, we're seeing mortgage demand decrease drastically. Mike Fratantoni, MBA's Senior Vice President and Chief Economist, he has something to say about this news. He said, mortgage rates moved higher once again during the first week of the fourth quarter of 2022, with a 30-year conforming rate reaching 6.81%, the highest level since 2006. Mortgage rates increased across all product types in MBA's survey. Application volumes for both refinancing and home purchases declined and continued to fall further behind last year's record levels. The news that job growth and wage growth continued in September is positive for the housing market as higher incomes support housing demand. However, it has also pushed off the possibility of any near-term pivot from the Federal Reserve on its plans for additional rate hikes. He is saying that application volumes for both refinancing and purchase loans have declined, and this is impacted with the news of the jobs report that recently came out and also wage growth continuing to increase, which is spurring the housing market to continue growing. However, the goal of the Federal Reserve is to pivot away from that, and this is only going to guarantee that the Federal Reserve is going to continue hiking the target federal funds rate until they can get unemployment rate back up and have inflation tamed down. So now that we went over the mortgage demand for the week ending in October 7th, let's look at the previous week to just get a better perspective. So the week ending in September 30th, 2022, the market composite index decreased 14.2%, the refinance index decreased 18%, and the purchase index decreased 13%. We're getting back-to-back weeks of decrease in mortgage volume. And if we look at that visually, I have the trading economics graphs right here. For the mortgage market index, this is just overall application volume. We're looking at 1 year. You can see how the decline has been consistent throughout the whole year, starting from November 2021. And 25 years, we haven't seen it this low since before the 2000s. If you look at the purchase index, you can see the exact same thing. For the whole year, it's been steadily declining as well. And you saw that 13% decrease that we were talking about earlier with the purchase index. This is people who have been applying for purchase mortgages to buy a home. And since less people are applying for mortgages to purchase a home, this ultimately impacts buying demand as a whole for real estate. So you can see it's really at a historic low. And we look at the maximum right here. It hasn't been this low since almost around 2014, 2015. If we look at the Mortgage Credit Availability Index, this index indicates whether lending standards are tightening or if they are indicative of loosening credit. So if we look at here, for October 11th, the MCAI fell by 5.4% to 102.5 in September. A decline in the MCAI indicates that lending standards are tightening, while increases in the index are indicative of loosening credit. Joel Kahn, MBA's Associate Vice President of Economic and Industry Forecasting, he said, credit availability fell to the lowest level since March 2013, the 7th consecutive month of tightening. With the likelihood of a weakening economy, which would lead to an increase in delinquencies, there was actually a small appetite for lower credit score and high LTV loan programs, along with a reduction in government streamlined refinance programs. As mortgage rates have more than doubled over the past year, resulting in a drop in refinance activity, lenders have worked to reduce excess capacity and costs by eliminating underutilized loan programs. All the component indices declined last month, with most of the indices falling to their lowest levels in over a year. You can see lender standards visually represented here, and it's very strict right now compared to the rest of the historical data. This could be a concern for people who wish to buy a home because it was already hard to buy a home even last year, especially qualifying for the mortgage and going through the underwriting process. But now it's much harder to get a mortgage, as well as already qualifying for it based on your income, down payment, and credit score already. So I briefly went over how the Federal Reserve looks at the jobs report as one of its main indicators for inflation. And with the most recent jobs report that came out for September, it was announced that the unemployment rate decreased from 3.7% to 3.5%, indicating that the amount of Americans that are looking for jobs decreased, which means that they're no longer counted as unemployed. But this article by the AP News titled "What Friday's Jobs Reports Means for the Fed's Inflation Fight," they had an interesting take on it where they said a diminished pool of people who are seeking jobs will keep pressure on employers to offer higher pay to attract and keep employees. Businesses will usually pass on these higher costs onto consumers, therefore increasing prices and feeding into inflation. When the unemployment decreases, that means less supply of people looking for jobs, meaning that businesses will have to increase or offer higher pay to keep those employees or attract newer employees, which ultimately makes businesses pass on these higher costs onto consumers and therefore increasing prices and eventually feeding into inflation. If we look closer at inflation, this is a great chart from the New York Times. It shows that it's now at 8.2% in September. And if you exclude food and energy, it's at 6.6%, which is actually the highest historically since the 1980s. Overall, prices for goods have increased by 0.4%. With that being said, I have the Fed Watch tool so we can confirm that my predictions are correct. So right here we have November 2nd, which is the next federal meeting. If you guys didn't know, we have 2 remaining meetings left for the end of the year where the Federal Reserve meets to determine how they're going to implement their monetary policy. And right now for the November 2nd meeting, it is predicted that the probability of a 75 basis point hike is 96%. So pretty much almost guaranteed that this will be the case for November 2nd. If we look at the final meeting in December, there's a 66.7% chance that there will be another 75 basis point hike, and 32.1% chance that there will be a 50 basis point hike for the last meeting in December 14th. Now, switching gears to the housing market, how has all this mortgage demand, the jobs market, the inflation report, how has this been affecting the housing market? Because that's essentially what we're looking at. So I have this great article by Redfin. It's called Housing Market Update, Lurching Mortgage Rates Spook Home Buyers. It's very seasonal article name with Halloween coming up. Here it says home buyers have lost 29% of their purchasing power since rates bottomed out in early 2021. Home prices remain elevated due to the low supply, but early demand signals weakened sharply last week. Obviously, we know that purchasing power has decreased tremendously since the increase in interest rates. There's less buying demand now, which ultimately impacts prices, and you'll see how much buying demand has decreased in this article. There's a lot of signals that demand is really weakening as we end off this year. Redfin reported home tours fell 7% and mortgage purchase applications declined by 13%. Redfin's Home Buyer Demand Index, which is Redfin's measurement of their requests for home tours and other home buying services that they offer, that fell 6% last week to its lowest levels since mid-June, when mortgage rates first jumped towards 6%. This is obviously when the Federal Reserve had their 75 basis point hikes during that time. Home buyers have lost 29% of their purchasing power as the average 30-year fixed mortgage rate jumped from 2.65% at the start of 2021 to 6.66% today. They have a really nice chart here where they show the relationship between how much home that you can afford with a $2,500 monthly budget and the increase in the interest rate. You can see on the y-axis you have home values, and then right here you have the years and the time. So as you see, mortgage rates have went up and down all throughout until you reach 2020, where it decreased all the way as low as 2.7%. And then after the start of 2022, obviously we know that rates have increased to almost 7%. And then you can see the relationship with home values. You can see the relationship with how much you can afford with a $2,500 monthly budget. At the start here, at the lowest point in 2021, when the rates were at its lowest, you could have afforded a home at $533,955 at a 2.6% mortgage interest rate. And now, since rates are now at 6.66%, that has dropped tremendously to $378,825. So you're essentially losing almost $200,000 worth of buying power because of the interest rate going up from at 2.6% to now 6.66%. So basically 4 percentage points. So some leading indicators that we have now for home buying activity is that fewer people search for the phrase homes for sale on Google. This data was retrieved on October 1st and was down 33% from a year earlier. The Redfin Home Buying Demand Index, like mentioned, is declined 10% in the past 3 weeks to its lowest point since the week ending in June 19th. The index was down 26% year over year and fell below the same level at the same time in 2020. The home touring technology company ShowingTime, they reported that touring activity for October 2nd was down 26% from the start of the year. The activity of people touring homes decreased by 26% from the start of January 2022. And if we compare October 2nd today versus October 2nd last year there was an 8% increase at the same time. So let's look at mortgage rates and what they are right now. For a 30-year fix, right now it's at 7.1%. 15-year fix, 6.31%. 30-year jumbo, 6.06%. 5-to-1 ARM, 6.35%. 30-year FHA, 6.62%. 30-year VA, same thing at 6.62%. In conclusion, we saw that mortgage applications decreased 2% following a 14.2% decrease in the week ending in September 30th. Applications for purchase loans dropped an additional 2.1% following a 13% decrease in the end of September. On top of that, lending standards remain very strict. The overall MCAI, or the Mortgage Credit Availability Index, decreased in September by 5.4%, which is the lowest levels since March 2013. The news didn't get any better as the unemployment rate remains low at 3.5%, which decreased from 3.7% in September. This essentially gives the green light to the Federal Reserve who are likely going to increase the federal funds rate further in their last 2 meetings of this year, with a 75 basis point hike in November and a 50 basis point hike in December. The housing market is also hurting. We saw in Redfin's housing report that touring activity was down 26% from the start of the year. Redfin's home buying demand declined 10% in the past 3 weeks, the lowest point since the week ending in June 19th. And lastly, rates are now at 7.1%, which is a 20-year high. In my opinion, the housing market is in a weird place where sellers are less inclined to list their homes unless they have to, like if they need to relocate, if there was a death in the property, foreclosures. Most homeowners are probably more likely to just sit back and hold tight and enjoy their low interest rates until things get back to normal. On the buyer side, with increased rates and increased costs of your everyday expenses, it's difficult for most to consider buying a home. I think these findings will only be elevated for the rest of this year and beginning of next year. But overall, for my buyers out there, if you guys are still looking to buy a home, I think it's still a great opportunity. Well, number one, median sales prices are down, so you're getting a good discounted price on real estate, which is obviously a great asset to own. Number two, with the increase in interest rates, there's a lot less buying demand for housing right now, so it's your turn to jump in, especially if you've been waiting in the sidelines for the past year. And number three is that there's a lot more housing options right now, especially with the increase in active inventory. You have a better chance of finding something that you like within the right location that you're looking for. So if you guys are looking for someone to buy a home with, feel free to contact me. DM me on Instagram at olivernpham. Also, you can email me at olivernpham@gmail.com. Okay, so with that being said, I'll see you guys in the next video.